Hi, everyone. I'm Steve Altition, Director of Client Partnerships here at Pacific Cascade Legal. And today I'm here with President of Woodson Wealth Management and founder of Allegiant Divorce Solutions, Jamie Lima, to discuss how you can prepare for and restore your financial well-being before, during, or after a divorce. Hey, Jamie, how are you doing today?
I'm well, thank you. Thanks for having me.
Well, thank you for being on. This is a great topic, by the way. This is the kind of stuff we really like. So before we start in though, can you just sort of tell us a little bit about yourself and how you got to be where you got to be?
Yeah, absolutely. And again, thanks for having me on. So I'll give you a little bit of I'll give you a brief background on myself. So I'm originally from the East Coast. I'm born and raised in a tiny little town in Rhode Island, but I now live in a tiny little town just outside of San Diego, California, called Ramona, California. And I started my career in the financial services industry way back when, like 2005, 2006 or so. I worked for a company called Morgan Stanley. And I left there after about 5 or 6 years and went to a company called Fidelity Investments, which everybody knows and loves, and launched my own company, Woodson Wealth Management, about 3 years ago now. It'll be 3 years ago. We're recording this June 20th here. We're going live on June 20th. July 1st will be our 3-year anniversary. So I'm very proud of that. And just more recently started focusing my time, energy, and efforts on more of the divorce financial planning. I went through a pretty rough divorce myself in 2017, and I'm the product of a divorce from my parent. My parents were divorced when I was about 7 or 8 years old. So it's been something that's been kind of the story of my life for a very long time. And it's a passion of mine and something that I really enjoy helping people navigate, because it can be very, very challenging.
Oh my God, yes. You're the perfect person to have. I mean, I was going to start with, but I don't really have to. We know that divorce can have a huge impact on a person, both, on their emotional and on their financial level. But you do say that the negative impact can be lessened by preparing for it and preparing for it early. You even talk about preparing for a divorce even before anyone has filed for divorce. So where can/should someone start thinking about preparing for that?
Well, I think I was reading a statistic the other day that said something to the effect that it takes men on average over a year to actually pull the trigger from the time when they figure that they recognize that they want a divorce to when they actually file their documents. Women, it tends to be a little bit faster in some respects, but for some reason, men, it just takes a little bit longer time. And that was me. I mean, it was one of those things where I knew that it was starting to. I just knew, right? I knew probably about 2, maybe 3 years ahead of the time when I actually asked for a divorce that it was probably that was where we were headed. And even as a financial planner, I could have done many more things and done a much better job of preparing her and myself for the divorce that was going to be coming here. And I think a lot of it comes down to the fact of really just trying to figure out what your post-divorce life looks like. And a lot of people are just so focused on the emotional aspect of things and maybe or have some concerns about the finances and what that's all going to look like and so on, at least while they're going through the divorce. But the thing that a lot of people fail to do is really just take some time to consider what the post-divorce life looks like, because that's where we can come in as financial planners and as financial advisors to help them figure all of that stuff out. So that would be the first thing I would start with. And then there are some mechanical things and some steps that they can take to actually, put themselves in a much better position. But we can talk about that here in a second.
So you used "we" a couple times. This is not a me against you thing necessarily. This is the better they both get out of it, the better everyone is. I mean, it feels like that to me, at least. So when should I start doing things like getting a hold of even my financial information? Because I know that I'm going to need it probably for a divorce coming up, but where and what kind of things would you be looking for at least?
Great question. And what we tend to see, as you probably can experience on your side of the table, when we work with clients that are going through this exercise, there usually tends to be one person that has all the financial information. And this is not to be sexist, but, and I've said this in other podcasts too, so not to be sexist, but usually it's the man who has been steering the ship from a financial perspective. They're the ones that have met with the financial advisor, or they've made all the investments, or maybe they were the breadwinner and they have the bigger 401k and all these things, and they tend to be leading the charge. And that was the same situation in my own divorce, where, you know, I'm obviously in this business, but even so, I was the breadwinner and I was one that was saving for retirement and doing all these things. And she didn't really have an understanding of really what was out there. So the first thing you can do, if that's you, and whether you're, whatever side of the coin you're on, if that's you and you're listening to this, I would say the first thing you want to do is start organizing that information, learning where the bank accounts are and how many credit cards do we have? How many brokerage accounts do we have? Are we using multiple custodians? And when we say custodians, we're talking about companies like TD Ameritrade and Charles Schwab and UBS and things of that nature. That's what a custodian is. And I would really just start figuring out, just get a lay of the land, so to speak, and try to figure out where all the all the assets are, and start to document it. And that would be a great first step. And I think, aside from the investment stuff, also the personal property. I would go room to room and start taking inventory of all the stuff you have. And because when you go into it, when you go into a marriage, there may be some things that may be premarital, right? Maybe you have grandma's fine china, or, there was a gift that was given to you along the way that you consider your separate property. And then you start to, over time, you start to commingle those things, and you start to, you have your furniture, then you have the family, the marital furniture, or different types of marital property, art and collectibles and things of that nature. I would start spending some time just documenting, where they came from, who owns what, and so on, because that will, if you work with your attorney and you work with a certified divorce financial analyst like myself, we're going to need that information.
Is this too early to start breaking away? And what I mean by that maybe is get a credit card of your own, or set up a bank account of your own. Is that something that they should be doing even before, or is that really something that doesn't necessarily have to happen, or is that a case-to-case kind of thing?
I think it's a case-to-case situation. I mean, if you feel like you're a year or two out, there's probably no real benefit of doing that. I say, once you've vocalized, or maybe you've even separated and you haven't really vocalized just yet that you want to officially go your separate ways, there comes a point where you're going to want to start having your own accounts. You're going to want to start separating those assets. And it's not because, and just full disclosure, do not hide money, and do not try to hide money, because we will find it. We will find it. And if we don't find it, the opposing counsel will find it. And so you just put it out of your mind. And we tend to see, again, not to be sexist, but we tend to see that the men try to do this a lot. But we do ultimately find that information. But there will be a point in time where I usually tell people, once you've figured out that you've officially separated it, it may be a good time to start building your own credit and start getting accounts in your own name. And because that'll be super helpful as you start to build your post-divorce life.
Okay, somebody files, and now a divorce is pending. I mean, obviously, I know there's got to be some difficulties in dealing with finances during the divorce, and not the least of which is something we see a lot, which is people trying to sell or transfer assets without the court approval or the spouse's approval. So when the divorce is filed and you're sort of now navigating through the divorce while it's still ongoing, and I came to you and you'd say, well, that's the first thing I should do, what would you say?
Relating to the finances?
Yeah. Well, actually, I could use a lot of help, but we'll start with that one.
Yeah, I mean, I think if once you've filed and you've started to build, because now you're transitioning from, you're not necessarily preparing for it any longer. Now you have to navigate the divorce process. And this can get sticky. And the reason being is because now all the emotions are flying everywhere, and you may not be in the right headspace to make good financial decisions. So to your point, I would not be making any major financial decisions while I'm going through this exercise. I wouldn't be taking out a car loan. You may have to go and try to find a new place to live, and that based on your circumstances. So that would be something that we could help you navigate and make sure you don't make any mistakes there. But I wouldn't make any major decisions. You can probably open up a credit card and start working on building out your credit for post-divorce, but moving assets around and closing accounts and all that other stuff, it can make things very, very difficult as you're going through the divorce process. And it may not look good either in the eyes of the courts if it looks like you may be playing a little bit of a shell game with some of the assets that you have, whether it's because you are trying to hide assets and information from your ex-spouse, or it may just be an honest thing that you're trying to do, but the optics of it don't look great. So I would avoid at all costs making any major financial changes at that point.
At some point during the divorce, it's going to come down to splitting assets, to the division of property. And I imagine that's when you kind of strap your boots on and can get involved, because I can come. What if I come to you and I say, well, hold it here. We have this bank account, and we have a house, and we have a 401k, and oh yeah, there's a pension. And so what should I take?
Yeah, this is where we earn our keep for sure as a certified divorce financial analyst and as a financial planner in general. I would say if we're being brought into the equation that far along, there may be some things that we need to go back to the drawing board on and maybe go back to the beginning on. I usually tell people that once you've decided that you're going to drop the D word and ask your spouse for a divorce, that's when you want to create team you. Right. That's when you want to, if you have to, and you think it's going to be contentious and you want to go through the proper legal channels, that's when you want to hire a great attorney. And you also want to hire your CDFA to help you with the financial aspects of it. Because as you know, Steve, we're experts in the financial aspect of it. You guys are experts in the legal aspect, and creating that team you can put you as the client in a much better position in the long run. So I think when it comes down to division of property, that's where people will really start to see the value that we can bring to this experience for them, because it's not always just about splitting assets down the middle. Retirement accounts have different tax implications of being split up than does your house or your brokerage account or your checking account. And depending on what kind of asset you have and how you hold that asset, whether it's in the name of a trust or whether it's in your individual name as an IRA or a 401k, there could be major tax implications of doing distributions and moving money around post-divorce. So absolutely. And that's I think it takes the most time for us as CDFAs, but it's only because we want to get it right. Yeah. And in my experience, it's as long as we have the information that we need to gather from you, we understand where all the bodies are buried, so to speak, as far as these accounts go, we can easily, give you a plan, a roadmap to show you and your attorney, like this is the most viable option for everybody. And it's not about, not to belabor the point, but it's not about trying to get one over on the other person and walk away, put yourself in a much better position, what have you. All our job is as CDFAs, and I think you would agree from a legal perspective, is just to make sure this is a fair and equitable settlement for all parties.
Yep.
Okay?
Yep.
So that's what we I think where we add the most value. We add a ton of value, but if you look at the overall engagement, that we can add a ton of value there.
We sometimes see, and I think maybe you do, the concept of time is not always included. And what I kind of mean by that is, well, here's $100,000 cash, and there's a $50,000 investment or something. And well, this has to be better than that. That sort of explaining of time. Can you just talk a little bit about how that can figure in? Because the divorce may be over in 8 months, but the rest of the time keeps going.
Absolutely. And that's, in our world, we call it's the time value of money. And that's what the term we use in our world. And if you have a retirement account that's earning you, let's just say, on average, it's 7 or 8% a year. Well, because of if you're taking the growth of that investment coupled with we're factoring inflation, which we're all feeling the pain from. We're looking at record levels of inflation that we haven't seen in years and years, that we're all dealing with right now. That $100,000 that you have in a savings account that's earning you, if you're at a traditional brick and mortar bank, you're probably getting 0.5% of interest on that account. If you have it at an online bank, maybe it's a little bit better. Maybe you're getting 3 to 4%, but it's still not 7 or 8%. So that's what we will look at, is the time value, how the time value of money will impact you. And we'll try to figure out a strategy to say, okay, well, how do we want to divide this asset up? Because you have one over here that's generating 7 or 8% a year. It may be a lower value right now, but 3, 5, 10 years into the future, there's going to be a point in time where the value of that account is going to be much greater than that $100,000 that's sitting there that's getting 0.5%. And let's also take into consideration the fact that 5 and 10 years into the future, the dollar that you have in your pocket today is not going to be worth that same dollar in the future because of inflation. So that $100,000 account may only be worth $70,000 in just a few years, based on the impact inflation has. So we have to take all of those things into consideration. And most people that go through this exercise avoid all of that. They just look at the snapshot in time.
Yeah.
This is what we have today. These were all the cards laid out on the table. This is what we have. How do we divide it fairly? And you have to take all these other things into consideration to ensure that 5 and 10 years in the future, you haven't shortchanged yourself.
Yeah. I imagine debts sort of work the same way.
Exactly. Mortgages and credit cards, and who's going to take what, because we see that happen a lot, where you have one person that takes, maybe there's some marital debt. They have a credit card or two that they've incurred some marital debt. And they say, well, okay, I'll take this debt over here, but you take that thing over here, and that just wipes it out. Yeah, not necessarily, because if you're paying 21% or 22, 25% on your credit cards over here, and this thing over here is only earned, only 5%, then there's the discrepancy in the interest rate and the overall cost that debt's going to cost you for however long you have it.
So at some point during the divorce, I know that, kind of part of what I do is start getting people to look at the post-divorce. And I'm assuming maybe at some point that happens to your clients. It's like, we're almost there. But I haven't really made any plans about what happens afterwards. And I just realized that, we no longer have one expense on 15 different things. We now have 2 expenses.
Yes. What you're talking about is like now you have, in some cases, now we have people that are supporting 2 households.
Yeah.
Right. You have it was the same situation in my case. I left after before the divorce was finalized, and my wife and my ex-wife, now we have 3 kids between us. And it got to the point where it's like, okay, after the divorce is finalized, I have my life over here that I have to rebuild. And I also have a family I have to take care of over here. And even though, again, this is one of those things where I should have worked with a CDFA to figure all of this out, because even as a certified financial planner myself, I wasn't in the right headspace going through my divorce. It was very contentious, and there was a lot going on. It wasn't by my doing, but and I have evidence of that. But I'm not just biased here, but I just wasn't in the headspace to figure that. Plus, I was working full time and everything else, so I didn't really project myself out 3 to 5 years after the divorce to try to plan accordingly. And so what we do now with the clients that we work with is, even when we start when we initiate the relationship, one of the very first exercises I'll take them through is goal setting. So we'll look at, what are your goals before the divorce, right? Like, and before and during the divorce. What do you want custody to look like, and child support and alimony and all those things? We'll just walk them through that. If they had a magic wand, like if you have a magic wand, what do you want this to look like? If you had to guess, what does your spouse want this to look like? Just so we can see if we can find some commonalities amongst the two to help with the negotiations and really lead the mediation process. But that also helps us define, what do we want the post-divorce to look like, and help them start to make realistic changes today, and in many ways really figure out, like, is what I want to happen after the divorce realistic based on what I have to work with at this point. And that includes, the assets and the budget.
Yeah.
So that's what we'll work on that early on.
Okay, you've done all this work with your client. I'm setting you up on this one. You've done all this work with your client, and the divorce is just about over. You've given them advice, and next time you hear from them is, a few months after the divorce is over, and they hand you the decree, and you go, "What the?" I always ask people, what would you say to someone about who hands you the decree and doesn't show it to you before they sign it?
I would probably take it and smack him in the back of the head with it.
I mean, that's your last bastion of sort of defense.
Yeah, you're absolutely right. I mean, once that decree is signed by the courts, that document is no longer living and breathing. That document is baked, and there's not a whole heck of a lot you're going to be able to do with it. Ideally, we're working with the attorney all along the way so that doesn't happen.
Yeah,
and that's where going back to creating Team U. And I'm not here to tell the attorneys how to do their job, and what my job is just to give them the facts.
Yeah,
and basically say, here, Mr. Mrs. Attorney, this is, mathematically speaking, this is the most favorable outcome for everybody. Or in some cases, it's, here's plan A, here's plan B, and here's plan C. These are the pros and cons. Let's figure out what's going to work the best for everybody, and what you think you can do and make happen in the most cost-effective way. Yeah. Once that decree is finalized, there's not a whole heck of a lot we're going to be able to do. Yeah.
So now we're done. The divorce is over, and you talk about recovering financially from a divorce. Now, I'm sure that you would rather you have been with them during the pre and pending stage, but even if they're not, they come to you after the divorce, can you still help them? What kind of goes on in the recovering financially from a divorce?
Absolutely. We usually will transition our clients from the divorce engagement over to a traditional financial planning engagement. And that's why we created two companies, one being focused on the divorce financial planning, which is Allegiant Divorce Solutions, and then Woodson Wealth Management, which is the company that I mentioned earlier that I started 3 years ago. And that's where we do our traditional wealth management engagements. And you don't have to have a lot of wealth to work with us, but because we work with some people that are really just starting off and trying to learn the ropes of managing investments and their cash flow and so on. So don't let the wealth management component of that to steer you from reaching out from us. But that's what we'll do. We'll shut down one engagement once the divorce is finalized and that everything is done. We usually transition them over, assuming they want to continue to work with us and they're still comfortable working with us in that capacity. We'll move them over to our traditional wealth management offering. And that's where we'll go back to basically square one. Let's look at the budget again. Let's make sure that what we thought was going to happen and what you thought your lifestyle was going to look like a week or two, or a couple months after the divorce is finalized. Are you spending as much as you thought you were? How do we make adjustments for that? And it may sound elementary, but it's so very important to start there. We'll go through and we'll look at every line item, credit cards, we'll look at bank statements, things of that nature, and just help them reorganize their newfound life. And then we'll start in on going back to the goals that we've set in the previous engagement and looking at, like, you told me 6 months ago or a year ago that this is what you envisioned your lifestyle to look like and what you wanted your life to look like. Is that still realistic? Is that still what you want now that you have some time to clear your head and catch your breath? And that's where we'll start. And it's a matter of really just trying to put a plan in place around that. So we try not to do too much all at once, and we'll slow roll it. But for the most part, it's just helping them transition and really get themselves back on their feet so they can achieve the goals and objectives that they have for the remainder of their life.
Yeah, I love that. I love that. And I imagine that you probably get, because we probably get to send you. A lot of times there'll be one of the spouses who comes out with a pretty good amount of assets, but they were never the person, like you said, who was doing the financial planning. They don't have a financial plan. They don't have maybe even an investment. They might have a retirement account from work, but now they've got some money. So are those kind of people? I mean, a lot of people think that, well, why would I go to them? I don't have any investments. And maybe that's a good reason to go to you.
Absolutely. And that's exactly who we work with. Usually it's maybe the house has been sold and now they have this lump sum of cash and they don't know what to do with it. Or they've had to, through the quadro, they've had to separate their retirement plans. Or you mentioned pension plans earlier. People that hold a pension plan are kind of the dying breed. So we're not seeing too many of those situations any longer, but we work with some older folks that are going through a divorce, and they may, they may have something that's still in existence. They're yeah, I mean, it's a matter of really just, again, going back to where we were before, which is just helping them figure out what their goals and objectives are and try to figure out a strategy around that, the assets that just landed in their lap, so to speak. And you're absolutely right. A good majority of people that do end up with this money, whether it's or an asset, whether it's the house or what have you, they're usually the ones that are coming to us because they haven't had to deal with this stuff before. Yep. And in many ways, because they don't teach you this stuff in school, we have to educate them on all this stuff. Yeah. Like, what is a stock? What is a bond? Just going back to the basics. And again, it may sound elementary, but we consider ourselves educators more than advisors most of the time. And that's what we'll do. We'll just sit with somebody and help them figure it all out. And yeah, it sounds very easy, but it's what we love to do it. I love to do it.
Yeah. So if, you get a lot of, divorces that are older people, and so they get divorced and they're, 7 years from retirement, 8, whatever. Is that too late to come to you?
Never. We deal with a lot of I think the term is called the gray divorce. The gray divorce.
What called now? My generation is now called the gray boomers.
The gray boom. Okay, I have not heard that. I have not. I'm going to use that. I'm jotting that down right now.
I like that.
That's excellent. It is not too late by any stretch. I feel like, and what I have seen is that people they've already spent so much money, or they anticipate spending so much money on their attorney, that they're afraid to add one more expense of hiring somebody like myself, or, and you don't have to work with me. I mean, any CDFA out there, I'm sure, you can find somebody in your neighborhood. But what I've seen personally is that people are a little afraid to spend money because they like, okay, we have a lot of expenses already, and now we have to pay for attorney, and he has to pay for an attorney, and then I'm going to add this financial advisor into the mix. I don't really know. It doesn't sound. Is there any value in it? But what we see happen is, because our rate is usually a lot less than an attorney as well, we can do a lot of the legwork of helping you prepare, even prepare a framework of settlement when it comes to assets and things of that nature, that you can then take to your attorney which is going to save a ton of money in the long run, because we can do it. Not only can we do it faster, but we have all the tools and resources that we can leverage that can make sure we don't burn your time.
Yeah.
But, I mean, our hourly rate is less, and we can do a lot of this legwork, and then you can take it to your attorney and say, okay, here's what we think is, and this is why. And we can write we'll write the settlement for you, and the summary. I'm sorry, we'll write the summary of the settlement and all these provisions and what have you. And then your attorney can take that and see if they can get a settlement without even having to go to court on that. And that's going to save a ton of money right there. Just so it's like anything else. Sometimes you have to spend money to save money, and that's kind of where we come in.
Well, that's exactly why we use you. I mean, that is one of the main reasons. It's that, you can get it done so that the case doesn't have to, go on and on and on. And, I always tell this, and people have heard it before, but you're the expert. I mean, yeah. I talk about when my kid was born, and we're all in the room, and the doctors, and they lift up, they go, "Do you want to cut the umbilical cord?" And I'm looking around going, well, isn't someone here more qualified than me? So, I mean, I totally get that. So, as having said that, we blew through 30 minutes. I would love to talk to you again, but for now, we have to go. So, thank you so much for sitting down today and talking about this. This is just great advice. Before we go, though, please tell people how they can get a hold of you.
I think the easiest way is just through our website, which is woodsonwm.com. All my contact information is on the website there. We're still working on a revamp of the divorce planning website, so that's not ready to go just yet. But woodsonwm.com will be the easiest way to reach out to me. My cell phone is on there, so you have access to my cell. You can call me or text me if you do have follow-up questions, and then my email address is on there as well. Easy peasy.
I love it. Thank you. So thank you again for joining us.
Thanks, Steve.
And thank you everyone else for joining us today. If anyone has further questions on today's topic, you can also post it here and we can get you connected with Jamie. So until next time, stay safe, stay happy, and be well.